Hi, all right. So this is chapter 8 on partnerships. So again, I sort of tried to highlight just before we finished the class on Friday that really this was just an extension of chapter 7, but just to sort of bring in partnerships. The rules do not change. So partnerships are made up of a group of sole traders. And if you remember your, let's get my pen working. If you remember when you studied partnerships, um, we really have just really a group of sole traders here kind of coming together. Sorry, again. Oh, yeah, we have a group of sole traders coming together to trade. So what we're really looking at here is how we sort of pretty much share their profits and then just apply the same CYB rules or the same sort of rules to get their tax profits, if you like, or their taxable profits. So let me just get this right. Okay, great. Just waiting for that. Let's get this right. Sorry, forgive me here. Let's start again. Let's get this pen color here. All right, there we are. So we're talking about partnerships. So let's go. And I'm going to again break this up into like hopefully 4 videos max, 5 minutes. So it starts off talking about what a partnership is, and sort of us allocating profits and losses. And we're going to jump straight. So let's just look at the big point. To be fair, in tax, there's only 2 big issues here, and the issues are what we refer to as salaries and interest on capital. Right? So if you remember, the basic principle, the basic premise was that you would have these 2 people or 3 people run a business, we'll get net profit. Before we share the profit according to some profit sharing ratio, we would sort of argue that some partners have come there with a brain and some haven't. So the one who gets a brain tends to do a lot of the work, so maybe they get a salary. So remember, we don't deduct salaries from the actual accounts prep for partnerships because really they are owners. So here we would first of all have to deduct salaries first. When I say deduct salaries, what we're really doing is debiting net profit and crediting the current account, if you remember any of this, of the partner as far as double entry is concerned. When I say debit the current account, I'm really saying debit the capital account ultimately, yes, with profit. I mean, it's profit in effect. We're just taking a share of that profit first for the respective um, respective partners. Then, of course, to encourage partners to invest money into the business, we always give an interest on initial capital invested or interest on capital invested. It's pretty here. Capital isn't changing, so we'll just say interest on capital. So it means that the more capital you invest, the more interest, the more, if you like, a share of the profit you will get before it's shared between all other parties. And this sort of seems fair, given that you can have different profit sharing ratios. It allows for that because we have this interest on capital. Great. So those are the 2 rules. I mean, if you remember partnerships, there was also something called interest on drawings, but we don't talk about that. That's not in your syllabus. So let's look at a simple a scenario here of what I'm talking about. So it says Phil and Dan have been in partnership for a number of years. It provides that you take a salary of 25,000 each, 5% on capital balances, and then at the start of on capital at the start of the business, and split the rest 60-40. So you can sort of see that there's some structure here. So if they make 74,000, what they're really saying is you've got 74,000. I mean, I'll show you how it's done here in a second, but it doesn't really matter. They're really saying that, well, first of all, give Phil and Dan 25,000 each. So that's their share. Take that as a share of profit first of all. So that's 50,000 knocked off straight away. So technically, with 50,000 knocked off, what you really have, right, is yes, you have 24,000 left to be shared. Then it now says give Phil and Dan, if you like, 5% on their capital balances. And then what they'll always give you in the exam is the initial capital balance. So you'll take 5% of this, 5% of this. They always think of it, I mean, technically it is a loan, if you like. Same principle. So 5% of that, 5% of that, and I'm just going to take the figures from here. So you can see 75, 65%. Phil and Dan, 3750, 3000. So 3750, 3000 all come off, and then you're left, if you like, with this figure of 17,250. Right now we can split this between both parties in the ratio 60 to 40. But along the way, Phil would have 25,000, he'd have 3,750. Here we are, and he'll also have his own share of that 17. And so ultimately, we are assessing Phil on 39,100, and we are assessing Dan on 34,900, and that comes to the 74,000. So that's the very first thing you need to remember. Then you can see that really, for Dan, if this business had been carrying on for a while, it says here their year end is the 30th of September 2017, 30th of September 2017. So this will get assessed in the tax year 1718, right? Just as normal, as though they were sole traders, 1st of October to that, and that's all we're fundamentally doing, right? I mean, that's the ballpark discussion of it. So yes, so you can see there, and they've done that there as well. So please do TYU1, and in the next video I will carry on with the next bit.